Why is it that the advanced economies are mired in a slump right now? It's not a depression. It's not, necessarily a recession anymore, because that but a slump, a period of subpar activity. And why are emerging markets doing better? Well, let me point to the charts. In the left panel, the bar chart shows gross external debt as a percent of GDP by region and country groups. The right panel shows a bar chart of whether the countries increased their debt load from 2003 to 2009 or reduced it. And what I would point out is that the region that we hear the most about in terms of debt difficulties right now, Europe, just check out the top bar. And let me say this, that when you look at that average debt to GDP for European countries, there is no such thing as your average European countries. Nordic countries right now have very low debt levels. But Ireland, which we hear so much about, gross external debt as a percent of GDP is 1,000. Put differently, debt is 10 times the size of GDP. The only other country historically that matched that was Iceland, okay, which had, of course, a major crisis in 2007, 2008. And again, at the other extreme, as I highlighted, Asian and Latin American and African emerging markets have much lower levels of debt and had reduced their debt loads during the 2000. Now, Japan is an interesting case worth mentioning here. Japan has, of course, been receiving massive attention in the media because of the horrible natural disaster that's befallen them. If I were to come and tell you, I know of a country whose public debts last year were 225% of GDP, and this year will probably be above 260% of GDP, I would tell you that country's going to be facing a near default, if not an outright default. Why hasn't this happened in Japan? Well, look there. Most of the debt Japan has is domestically held. This is pension funds in financial institutions. They do not borrow much externally. That's something that I will come back to later on in my lecture. So where are we? As I tried to highlight early on, what I'm trying to do is trace out what the history tells us for where we're going. One of the things that we highlighted in our work on the aftermath of financial crises is that financial crises cast a long shadow. And, it was to me stunning in the financial press how long it has taken for the realization that your average post-World War II recession in the United States is not a good benchmark for comparing where we are now. Because the average post-World War II recession in the United States lasted less than a year. And the average post-World War II recession in the United States did not involve a record nearly 40% decline in real estate prices, which is unprecedented in the history of the housing market as measured by Case-Shiller. That series begins in 1890. So we suggested, our Reinhart and Rogoff suggested that the consequences were lingering increases in government debt because of poor economic activity, because of slow recovery. And in January of 2009, when we presented these results at the American Economic Association meetings, what this bar chart showed when we presented it there, we highlighted that this bar chart simply shows that if you look at the worst post-World War II financial crises, the average increase in public debt, this is not public debt as a percent of GDP, but real public debt, nearly doubles. So if in the year of the crisis, debt is equal to 100, it equals 186 3 years later. In other words, it's almost twice as big. When a number of people commented that we were being somewhat sensationalist at the time when we put out these numbers. Now they actually look quite modest relative to what we've seen in a number of countries. Now, here's the debt with drama that we're seeing in Europe. Public debt buildups historically have ended up with a high incidence of default. And let me define default, okay? And don't let the financial press fool you. Anything that changes the terms, that makes the lender worse off, when maturities are extended, when interest rate costs are trimmed, that's a restructuring. And a restructuring is a partial default. So when people talk, is Greece going to default? They're actually talking about, is Greece going to default on its private creditors? Because it's already defaulted on its official creditors. The package announced a couple of weeks ago, which entailed a lengthening of maturities and a trimming of interest rates on official creditors, is a restructuring. But it's not yet a private restructuring. It's an official restructuring. So what does this chart show? Just very quickly. The blue line is simply public debt to GDP. It's a plain vanilla arithmetic average for 70 countries, which account for about 95% of world GDP. The yellow shading is the share of countries in default or restructuring. But let's bring it to the, so bottom line, whenever public debt has soared so quickly, spiked so quickly, as we have seen in the last few years, look at those last observations to your left there, okay? Whenever the public debt has risen worldwide that much, the worldwide incidence of default episodes has increased with it. I don't think restructuring is avoidable, even with very large sums of assistance, which they are no doubt getting. Just to put this in perspective, people are accustomed to hearing, well, Ghana defaulted, or Ecuador defaulted, Argentina defaulted. But the idea that a European country is defaulting is somewhat more, has a more of a novelty ring. But let's go back to history for a moment here. What this chart shows is public debt to GDP for Greece from 1848 onwards. Okay? Greece obtained independence in 1830. The yellow shade, I didn't have data for the period 1830 to 1847, so the series begins in 48. But the yellow shading is years in default or restructuring. And in effect, since independence, Greece has been in a state of default or restructuring about 48% of the time. Bottom line, default or restructuring is nothing new. And I can go down, the advanced economies do not have the impeccable credit history that everyone thinks they have. In 1933, the United States defaulted on its Treasury gold obligations. The abrogation of the gold clause was nothing less than a default, because anything that changes the terms. So if you had bought a Treasury bond in 1919 or 1920, that treasury bond had a clause that said that's payable in gold. In 1933, that clause was scratched. And it was only payable in currency, in dollars. But guess what? The gold content of the dollar had fallen by about a third. So what I'm saying is these things that we now sort of look at with shock and awe is because we have focused too much on the last couple of decades where these sorts of things did not happen in advanced economies. But if you go further back, you will find plenty of action. Okay, what about debt and growth? This is what I call debt without drama. So you have a buildup in debt, but you don't blow up. I mean, in the sense that you don't have a sovereign crisis. What does it mean when a country has a very high level of debt? And we said, let's look at years in which public debt as a percent of GDP is between 0 and 30%, 30 and 60, 60 and 90, and then really high debt above 90%. What this is a frequency distribution of debt to GDP from 1946 to 2009. Our basic result was that at 90% or higher, growth deteriorates, and median growth rates fall by about 1%, and average growth rates fall by about more, and that's what this graph shows here. A different way of saying it actually is that there's a whole range of debt outcomes in which there's no relationship between debt and growth. Because it doesn't matter whether you have 30% debt or 60% debt from the growth standpoint. It's only when it gets to very high levels that you have a problem. But now let me turn to emerging markets because I want to remain in the spirit of the international scope of this wonderful Gorlin tradition. What about emerging markets? The emerging market problem is a different problem right now. They're not highly indebted right now. I mean, if you look at Latin America in the 1980s, then the problems were quite similar. The debt overhang, the so-called lost decade of Latin America, had importantly to do with a huge debt overhang, public and private debt, and a very, marked deterioration in the economies and in the standard of living in many Latin countries. But that's not the situation that emerging markets are in right now. Emerging markets have to be very careful, though, about borrowing a lot because emerging markets, what I want to reiterate is that emerging markets, while their tolerance for debt, for public debt, according to our work, is not that different from the advanced economies, their tolerance for external debt is not very high. This is what Ken Rogoff, Miguel Sebastano, and I have called debt intolerance. Debt intolerance is nowhere more, I think, clearly manifested that if you were to look at every single emerging market default since 1945, you will find that the majority, over 50% of those defaults, were at debt to GDP levels, external debt to GDP levels that would have met the Maastricht criteria. And the Maastricht criteria is 60%. Okay, so the idea of an emerging market getting to, debt to GDP of 500, which is roughly where the UK is, or 1,000, which is roughly where Ireland is, or over 200, which is where Greece is. That's just unthinkable. Emerging markets start to have problems at much lower levels of debt. That's why they're also policymakers in emerging markets are so worried about getting big capital inflows. Because, let me put it in English, capital inflows, if you have a capital inflows, it means you have a current account deficit, a trade deficit. And capital inflows is a polite way of saying you're borrowing from the rest of the world. Okay? And so if you look at all the advanced economies that have had big-time crises since 2007, the United States, the UK, Ireland, Iceland, Spain, Greece, and so on, all of them had large capital inflows. We have been borrowing and continue to do so from the rest of the world. That's a dangerous proposition, especially, it's a dangerous proposition for anyone, as we're finding, but it's a particularly dangerous proposition for emerging markets which have lower debt tolerance. These large capital inflows, they don't come out of the blue. You look at right now the financial industry. The financial industry is dealing with nominal interest rates in the advanced economies that are very low. Real estate markets that are very depressed, so rates of return on real estate are limited to negative. And that's not just a U.S. issue. I actually collect the data for real estate housing prices globally to the extent possible, because this is a series that, you know, it really is the proverbial needle in the haystack, finding reliable real estate data. But to the extent possible, the pattern of the boom and then the subsequent bust is very much not just a U.S. phenomenon. So nominal interest rates are low, returns on bonds are low, real estate is not attractive. So what is attractive? Well, the equity market has been volatile, but, you know, done pretty well. But emerging markets have been presenting a higher rate of return alternative. And so capital has been flooding, and these large capital inflows, however, have historically tended to end badly. Now, these capital flow bonanzas, for example, what does this chart tell us? I'm going to show you several of these charts, so let me explain them in as much as I can explain it properly. The red bar, this is by country. The red bar is the probability of having a banking crisis for that particular country. You know, the unconditional probability. That's the odds that you will have a banking crisis at any given year, based on your historic pattern. The blue bar is the probability that you will have a banking crisis if you've been getting a lot of capital inflows. So if capital inflows are a dangerous proposition, the odds that you will have a banking crisis are bigger if you're borrowing from the rest of the world than when you're not. This is what this is essentially showing. You're more vulnerable to banking crisis. You're more vulnerable to sovereign default. You're more vulnerable to inflation crises, and we're already seeing the inflation crisis story play out here. So if you go to any emerging market gathering, such as the ones in Davos, for example, what is the common chant or the common complaint that you hear right now from emerging markets? They're worried about inflation. Why are they worried about inflation? Because, well, capital inflows are not an unmitigated blessing. If you have a big inflow of capital, you have a big increase in the demand for your assets. So your currency appreciates. Okay, so countries are willing to tolerate a certain amount of currency appreciation. Well, not all of them. China has a fixed exchange rate, so there's no nominal exchange rate appreciation. But a country like Korea or a country like Chile, a country like Brazil has tolerated, a country like South Africa has tolerated a certain amount of appreciation in their exchange rate. But then after a while, what happens is policymakers get very nervous about becoming uncompetitive. And they start to intervene, to buy dollars and sell local currency in an effort to prevent the exchange rate appreciation. But what does that happen? It means that you're printing, the Chileans are printing pesos, the Koreans are printing won, and that creates a management issue for controlling inflation. Money growth and credit growth are build up and inflationary pressures rise. And that's a conjuncture that we're in right now with emerging markets. For advanced economies, problems are high unemployment, subpar recovery, including subpar recovery in housing, and big debt overhangs. For emerging markets, what are the issues? Big capital inflows, avoiding indebtedness, and inflation. And so let me point out that there are no quick fixes. I mean, I am still waiting for the day that I will go to the doctor and they will tell me, look, Carmen, you can lose weight without dieting and without exercise. But that hasn't happened yet. And unfortunately, the situation of overcoming a debt overhang is a lot like that. This is our debt profile. This is our total outstanding debt, public and private. And you see that there is some deleveraging since the crisis, but those debt levels remain extremely high. So how many of you have heard in the press about the new normal? You know, the reference to the new normal. Well, let us bear, and anyone interested, I'd be happy to send you the work that Vincent Reinhart and I did for the Jackson Hole Conference. We don't think the new normal is an apt characterization. The new normal has a sense that the old one was normal. That is, that the 10 years before the crisis were normal. In effect, they were not. Look at that buildup in debt. Look at that red line soar in the 10 years before the subprime. We had, as many countries in Europe had, a debt-fueled expansion. And the unwinding of that is going to be a long haul. I know that it's not uplifting, but it is honest. And since I'm not running for office, you know, I can at least be honest. No offense to anyone, but okay, so now what does this mean? So I've painted a picture in which the advanced economies are facing a fairly protracted period of subpar growth, but have to deal with the fact that there's a lot of debt, public and private. And let me say that the distinction between public and private is a very elusive one. Because in the United States, in the first quarter of 2010, Fannie and Freddie, which were the giants that were still, if you looked at the balance sheet of the U.S. economy, up to 2009, Fannie and Freddie were considered private entities. Only in the first quarter of 2010 where they shifted to the public sector balance sheet. And take a guess how much that added to U.S. government debt. 25 percentage points. So if you look at, this is not seat of the pants, and I'm not making this up, go to the flow of funds data of the Federal Reserve, which is what I'm showing here. And when you take federal debt, net, not even gross debt, net debt, so you're netting out the Social Security stuff, state and local debt, and state enterprise debt, that level for the public sector is about 125% of GDP. That is an all-time high, and it has surpassed the previous high, which was in 1946. You know, when people hear the term financial repression, they think I'm going to talk about emerging markets in 1980s, or I'm going to talk about China, because China has financially repressed system. We know they have capital controls, they have interest rate ceilings, they have directed credit, all these things, interest rate ceilings, directed credit, capital controls, all of that are forms of financial repression. But the fact is, all the advanced economies after World War II had very tightly regulated financial markets. This is for all the advanced economies. From 1945 to 2009, there are two frequency distributions. The blue one shows real interest rates, that is nominal interest rates. So let's say a treasury bill yields 2%, but inflation is 3%. then your real interest rate is minus 1%. It's negative. So the borrower, in this case the government, is receiving a transfer is being subsidized by those that hold government debt. And in the blue frequency distribution, these are real interest rates on treasuries during the financial repression era. And the purple frequency distribution are in the more liberalized era of 1981-2009. What I'm suggesting to you is that purple distribution is heading south. That we are going to see, because governments in most of the advanced economies are tackling a huge debt overhang, that we're likely to see measures. We won't call it financial repression. It's not politically correct. We're going to call it prudential regulation. In the early 1990s, when liberalized and laissez-faire capital markets and laissez-faire financial system were the things that were hot, the fashion of the day. And Chile introduced capital controls to keep too much capital from coming in. Chile was widely criticized. Now, Chile, Malaysia, Brazil, India, and others have moved more towards control-like measures on inflows based on the prudential considerations that we saw. High capital inflows make you more crisis prone. So it's not crazy to talk about measures to keep capital at bay. What I am getting at is that we have moved from a period of very repressed financial systems, right after World War II, during the Bretton Woods era in particular, to very liberal globalized capital markets in the 1990s and 2000s, and that we're moving to more controlled environment in the years forward. And the aim of that is to keep, very clear aim, to keep nominal interest rates low. And keeping nominal interest rates low helps reflate what are very depressed asset prices. It could also help with the unemployment situation by making working capital for the firms cheaper. But importantly, it also keeps interest costs for the government at bay. And so, how does this happen? I mean, it's much more straightforward to talk about controlling financial markets after World War II. After all, look, you know, most of the world had been through first the Great Depression and then a global, a world war. So countries had a lot of capital controls in place and such. Very different situation from now. I think you don't look for announcements that we're going back to Bretton Woods or that financial repression, the Financial Repression Act of 2011. What you look for are measures, prudential measures that foster financial institutions holding more government debt. Let me give you a concrete example. The UK, which next to the US is the most laissez-faire of capital markets. During the height of the crisis, the Bank of England raised the requirements of gilts that banks had to hold. Now, mind you, when Brazil did exactly the same thing under similar circumstances in January 1999, it was called capital control. So we can call it different things, but I think as we move forward, the scenario that I want to leave with you is a scenario where we don't go back to the old normal, which wasn't normal, but we have, this is not gloom and doom and the end of the world, but it is a much more subdued scenario in terms of growth, in terms of employment, and in terms of the fact that deleveraging does not happen quickly. In the work that I did with Vincent on the aftermath of financial crisis on after the fall, we show that private deleveraging takes on average about 7 years to unwind. On that uplifting note, I will like to take questions.